Good morning, I'm Johanna Gautier Morin. I'm a research fellow at the European University Institute in Florence, and today I'm going to talk about the sociological impact of the automation of trading on stock markets. The automation of trading has, perhaps counterintuitively, democratized access to stock markets. Originally, only licensed brokers and dealers were allowed to trade on the markets, so anyone wishing to buy or sell stocks had to go through their services. Nowadays, we live in a completely different world. Remember what happened last year when amateur investors went after shares of companies like GameStop. They did so through a commission-free brokerage app called Robinhood, after netizens declared war on the Wall Street establishment on an online forum called Reddit. So you see how far we are from the old-fashioned clubhouse where brokers used to gather to read newspapers before they went trading for 2 hours a day. What triggered the automation of trading historically was the need to cope with the problems faced by back offices on the stock markets. It happened when trading volumes were exploding in the 1960s and 1970s, which made it difficult to cope with the clearing and settlement of orders. To get an idea of these booming volumes, think that in the mid-60s, 5 million shares were traded every day on the New York Stock Exchange. By the end of the decade, volumes sometimes exceeded 20 million shares. So traditional methods for processing securities transactions were inadequate to handle such large volumes. The first computerized screen-based trading system, Instinet, was launched in 1970 by two Wall Street analysts who sought to reduce trading costs and cut out intermediaries. So Instinet's private electronic communication networks allowed its clients, and they were mostly banks, to buy and sell stocks anonymously by bypassing traditional middlemen. A year later, in 1971, the first electronic stock exchange, Nasdaq, was created. So these two alternative trading venues prompted regulated markets to launch their own automated system to cope with the competition. It started with the New York Stock Exchange, and other international markets followed like dominoes around the world very quickly. From that point, automated trading created new career opportunities and eliminated all tasks. You can think of what we called the chalkies, the people who used to chalk up the bids and offers of operators on big blackboards. Likewise, you can think of the fact that mechanical calculation machines replaced the people who used to do the calculations by hands. And most of the time, these people were women. But at the same time, the introduction of computers on the trading floors created new opportunities, and some pioneering banks immediately adapted to this changing environment. They recruited high numbers of scientists and PhD holders who were able to work with computer programs. For example, when Citibank bought Quotron, the first financial data technology company that broadcast quotes on electronic screens instead of the printed traditional ticker tapes, Walter Wriston, the CEO of Citibank, recruited an army of young quants who could run automated transactions and computerized financial equations as leverage to get ahead of his conservative competitors. The financial sector gradually appeared as a rewarding career path for young scientists. So many university programs in natural sciences opened minors in economics and applied finance to meet with the demand for relevant scientific skills. The proportion of people with degrees in engineering, mathematics, physics, natural sciences, and obviously computer sciences has steadily increased in financial firms. These new opportunities have not only attracted students, but also tenured faculty. Think, for example, of the two Nobel Prize winners, Robert Merton and Myron Scholes. They were professors at Harvard and Stanford, and they were also the founding partners of a famous asset management firm. So in the end, the democratization of stock markets through the automation of the trading processes has not been that simple. The hyper-specialization of market activities also met with the challenges of the global and gender division of labor. On the one hand, the growing importance of mathematical and scientific skills has fostered the social renewal of elites based on more meritocratic selections, and it allowed for greater international integration. But on the other hand, the increasing complexity of the nature of trading and the gender divide of academic specializations has also reinforced social and gender exclusions. It also increased the gap between super specialized scientists, public regulators, and lay people willing to pursue the modern financial dream. This raises a lot of questions about the viability and social role of popularized access to online trading platforms. And this is a democratic debate we should have in the coming years.